Ever wonder why investors get more excited as stock prices rise? Or why people hesitate to sell when the market starts to tank? Why do they often wait it out as a stock takes a nosedive, only to sell at the bottom and then watch helplessly as it bounces back to new highs? Contrarian investing. In this video, we'll break down contrarian investment strategies that can help you navigate tough times. Investing is really a weird business. The stock market is the only place where people want to buy more of something as its price goes up. This doesn't happen with cars or houses. Usually, people try to negotiate better deals, look for discounts, or wait for sales to get the best price. But in the stock market, it's the opposite. The higher prices climb, the more people want in. Of course, a savvy investor should do the opposite. When stock markets start to rise, many people are hesitant to dive in right away, but get interested after prices have been climbing steadily for a while. On the other hand, when stocks start to fall, most investors don't feel fear right off the bat. Their confidence is boosted by the market's recent upward trend. Contrarian investors, however, buy when bad news breaks and sell when good news rolls in. It's true that out-of-favor stocks generally carry less risk because bad news is already factored into the price. In a declining market, this means that stocks near their lows tend to fall less than those near their highs. Of course, succeeding as a contrarian investor isn't just about going against the crowd. If it were that easy, everyone would be doing it. Being a contrarian means not only going against the crowd, but also knowing when to act on that difference, specifically buying when a stock is undervalued compared to its fair value, or selling when it's overvalued compared to its fair value. The half-off rule. A stock needs to drop at least 50% from its highest closing price over the past year to qualify as a contrarian opportunity, but that's just the beginning. Many investors think that complex systems are the key to making money. In reality, simpler systems often work better because they have fewer moving parts and less room for error. Before you even think about buying a stock, it needs to have fallen at least 50% from its 52-week high. For example, if a stock's 52-week high was $50, you wouldn't consider buying it until it dropped to $25 per share. This rule is non-negotiable. Never break it, no matter what. The half-off rule helps spot contrarian stocks and gives us a neutral gauge of how the crowd is thinking. Studies show that stocks that fall by at least half tend to outperform the broader market over the next 3 years. Stocks that have taken a big hit are less likely to keep falling and often bounce back strongly when things turn around. Just because a stock has dropped by half doesn't mean you should automatically buy it. This just means the stock is worth looking into as a possible contrarian play. Confirming indicators. To confirm a stock's potential, it needs to meet one of two conditions after a 50% drop: either significant insider buying or at least 2 of the 4 fundamental indicators. 1. Insiders. When company insiders make substantial investments in a stock that has dropped 50% within the first 6 months, it's a strong buy signal. These purchases must be made in cash by senior company executives or employees. Insider purchases must total at least $120,000 to be considered statistically significant for analysis. The higher the total purchases, the stronger the signal. This $120,000 threshold can be met collectively by multiple insiders. A 50% stock drop followed by insiders investing their own money is seen as a positive sign for the company's future. Research shows that insider buying is a reliable buy signal, but insider selling isn't as reliable for selling. If insiders or savvy investors like Warren Buffett or Michael Price aren't buying, focus on fundamental indicators for confirmation. The second condition for the buy rule is that at least 2 of these 4 fundamental analysis indicators must be met. Price-Charge Earnings (PE) ratio less than 12. This uses trailing 12-month earnings, not projected future earnings. Stocks with PE ratios below 12 are often undervalued compared to their future profit potential. Studies show that companies with low PE ratios tend to outperform those with higher ratios while posing less risk. Notably, top fund managers point out that interest rates and PE ratios are inversely correlated. When inflation and interest rates rise, PE ratios typically decrease. In today's market, if interest rates are sitting at 10%, Landing a 10% dividend yield from a company that's actually growing is pretty amazing. So in that kind of environment, spotting a price-to-earnings ratio, what folks call the PE ratio, around 6 or 7, could be a real opportunity. But if interest rates shoot up to 30%, you'd have to hunt for stocks with a PE ratio as low as 2.5 just to match what you'd get from those high interest rates. Even if you stumble on a stock paying out a 20% dividend, you'd still want to see a PE ratio around 4 to really make it worth your while. Honestly, something like that usually only makes sense with companies handing out really hefty dividend checks. At the end of the day, just looking at the PE ratio won't give you the full picture. But it's a pretty solid starting point if you're out there hunting for undervalued stocks. If you spot a stock with a price-to-free cash flow ratio under 10, research says these usually beat the ones with higher ratios in the long run. Free cash flow is basically the cash a company has left after covering the bills. Money it can use to buy back its own stock or pay out bigger dividends. So, when you pick up a stock with a low PFCF ratio, you're basically getting that company's cash flow on sale. If a company's price-to-book ratio is below 1, meaning the stock trades for less than the company's book value per share, that's usually a sign there might be a bargain, and it can be a smart move if you like to go against the crowd. The price-to-sales ratio is another one to watch. If it's under 1, that means you're paying less than $1 for every dollar of sales. And let's face it, sales are what keep the lights on and bring in the cash a company needs to turn things around. So if a stock is selling for less than its per-share sales, Wall Street usually calls that undervalued. Just like with low PE, PB, or PFCF numbers, a low price-to-sales ratio could mean the company is out of style right now, which might be your chance to scoop it up for cheap. It's usually a good idea to take a closer look if a company hits 3 or 4 of these value ratios. But here's a word of warning. If a stock checks every single box, it could be so beaten down that it might not make it. If a company passes 3 or 4 of these tests, make sure to see if insiders like CEOs or board members are buying up shares. That's a big clue. It can help you spot whether they really believe a turnaround is coming, or if things are about to go south. Secondary rules. It's often better to buy fewer shares of high-priced stocks than to purchase a lot of low-priced ones. Although many investors think low-priced stocks offer more leverage, they often come from lower-quality companies. Since you're already taking on risk, steer clear of speculative stocks to avoid adding more pressure. Stick with companies that have a market cap over $150 million. Market cap is the total number of shares multiplied by the current stock price, a key metric for comparing a company's value, reliability, and size. Big companies rarely go bankrupt, so following this rule helps you avoid firms with shaky futures. Smaller companies can be tricky because they have fewer shares floating around, making them more susceptible to manipulation. View management changes in struggling companies as positive signs that could indicate recovery potential, like bringing in new CEOs or leadership teams, which might stabilize stock prices as investors take a wait-and-see stance. When making tough investment decisions, consider factors like brand reputation, product offerings, and company size. Prioritize industry leaders that are unlikely to collapse unless there's a rare, sector-wide downturn. Look for one-time event stocks that experience sudden drops due to external factors like canceled orders, accidents, or obsolete inventory expenses. These stocks often have stabilizing fundamentals that can create contrarian investment opportunities.